Good morning and welcome to the Shenkman Wealth Management Fall Webinar Series. This program is entitled Taxation of Supplemental Needs Trusts. Before we get started today, I just want to say that on behalf of Shenkman Wealth Management, I just want to express our support and solidarity with the people of Israel during this difficult time. Our prayers and hearts are with the families of the victims, hostages, and the soldiers on the front lines battling the Hamas terrorists. May this war be one step closer to lasting peace in the region. And now back to our regularly scheduled program, which is, by the way of background, for those who don't know me, my name is Jonathan Shenkman, and I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning, and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in a variety of different periodicals, including Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, and Trust and Estates Magazine, to name a few. You can also see my work on my website at shenkmanwealth.com/articles, or by following me on social media at Shenkman on Money. Additionally, I just launched my podcast, which is also called Shenkman on Money, and you could check that out on Apple, Spotify, wherever you get your podcasts. Just one more quick administrative note. In the course of my practice, I recently noticed more and more professionals have been laid off due to the slowing economic environment. So as a service to my audience, to these webinars, if you're out of work and looking for a job, or if you're an employer looking to hire, please let me know, and I'll try to connect you. I don't do headhunting professionally, but if I can help out during these challenging economic times, please feel free to reach out to me directly. Okay, with all that being said, now to our esteemed presenter today. Today, we're privileged to hear from Amy O'Hara, a partner at Littman Krooks based in Westchester, New York. By way of background, Amy focuses her practice on special needs planning, trusts, estates, elder law, and personal injury settlement consulting. She's a sought-out lecturer and frequently speaks to advocacy organizations on the importance of proper planning for families of children with special needs. She regularly publishes articles relating to elder law, estate, and special needs planning. Amy is certified as an elder law attorney by the National Elder Law Foundation and is a member of the National Academy of Elder Law Attorneys. She's the treasurer of the board of directors of the Special Needs Alliance and is the president of the board of directors of Westchester Disabled on the Move. Today, Amy will be speaking on taxation of supplemental needs trusts. And with that introduction, I will now turn the program over to Amy.
Thank you, Jonathan, for having me. I appreciate it and to come back here. So I'm going to get right started because I have a lot to cover in a half an hour here. There we go. So what's in a name? And, Jonathan, I just noticed said, because I said taxation of special needs trust, and he used the word supplemental needs trust, and those terms are used interchangeably. So there are two types of special needs trusts that we really look at: self-settled or first party, or sometimes in my world, we refer to them as D4A trusts and third party trusts. And special needs trusts are also referred to as supplemental needs trusts. The distinction between first and third party is actually the source of funds. Trusts for individuals on means-tested government benefits, including supplemental security income and Medicaid, which are the two most common types of means-tested benefits. These types of trusts must be the special or supplemental in order to maintain eligibility for these government benefit programs. Those terms, supplemental and special, do not need to be in the title of the trust, but it's actually how the trust is actually written is what's important. Just a summary of a first party supplemental needs trust. We have a federal statute, 42 USC 1396 PD4A, and that's where sometimes the D4A reference comes from, which governs these types of trusts. They are self-settled trusts where the beneficiary can actually create their trust on their own, But sometimes they lack the capacity to be able to do that on their own. So then the law allows their parent, grandparent, guardian, or the court to be able to step in the shoes of the beneficiary to create the trust on the beneficiary's behalf. They're funded with the beneficiary's own assets. Sometimes they may become disabled later in life. And then we need to move maybe through a terrible automobile accident, and where they, need around the clock 24/7 care. And if they're under 65, we can move their own assets into the trust. Sometimes, a grandparent, or if a parent never did their estate planning properly, the beneficiary may get an outright inheritance. I work with trusts with personal injury bar, where there's medical malpractice settlements or birth injury settlements that go into these types of trusts. And the child is quite usually significantly disabled, needing that Medicaid and sometimes round-the-clock care. And another common funding of this type of trust is child support, because in the eyes of the government benefits, child support is actually an asset of the beneficiary. As I just mentioned, the beneficiary must be under the age of 65 when the trust is established and funded. The trust must be irrevocable, and all the assets in the trust are exempt and not countable as the beneficiary's own assets, so it allows them to qualify for SSI and Medicaid. Distributions are for the beneficiary's sole benefit. Now, distributions can be made to third parties, but they're for the benefit of the beneficiary. At the end, with the first party trust, at the end of the beneficiary's lifetime, to the extent that they used Medicaid, there is a payback for all the Medicaid that's been paid on the beneficiary's behalf through their entire lifetime. And then the remainder goes to the beneficiary's estate. So when we're looking at first party trust, remember, we're dealing with a self-settled trust here. These are typically taxed as grantor trusts. A grantor trust is a trust whose existence is ignored for income tax purposes, meaning if the trust has income, it is taxed as if the beneficiary had received the income directly, even if no income was distributed to the beneficiary, but rather remains in the trust. And first party trusts are almost always grantor trusts for tax purposes. And so again, that means that the trust incomes, deductions, credits are reported on the beneficiary's personal income tax return. This is helpful often because the tax rates are generally higher than individual tax rates. They're compressed. And especially for beneficiaries with disabilities with little to no income, so they virtually may be at the lowest tax rate. And so it's better to have that tax at the beneficiary's rate. First party special needs trusts are not qualified disability trusts, which I'm going to talk about when we get to the third party trust. Again, these are self-settled trusts. They're established by the beneficiary. Distributions are made for the beneficiary's benefit, and at the end of the beneficiary's life, any assets remaining are payable to the beneficiary's estate. And as a result, these trusts are includable in the beneficiary's gross estate for estate tax purposes. Dealing with much higher estate tax thresholds right now, it rarely becomes an issue where we're dealing with a taxable estate for a beneficiary. Typically, they're in situations where the beneficiary did have that medical malpractice or a type of birth injury case where there's millions of dollars in these trusts. There is a step up in basis because the assets are includable in the beneficiary's estate. There's a step up in basis of the trust assets, and Medicaid, to the extent there is that Medicaid lien that has to be paid, it's a deduction on the estate tax return. Excuse me. So third-party supplemental needs trusts, and so I'm going to spend a little bit more time on this because there's lots of planning that goes into how we want to structure these third-party trusts. But there is no federal statute on these types of trusts. There's some state statutes. New York has a statute under our state's powers and trust law that could govern both first-party and third-party. But the idea with these trusts is they're established by a third party. They're not established by the beneficiary. It's a common estate planning tool that I work with my families where we're anticipating one of their children to have lifelong needs that need to rely on government entitlement programs. This is the common type of trust that we'll use so that they can maintain eligibility and not really be disinherited by leaving assets to other children to quote unquote do the right thing, which, you know, if there's any estate planners here on the call, we see what happens from time when that happens. So this is a discretionary trust. We do not have a distribution standard based upon a health, education, maintenance, and support. It's important not to give the beneficiary with disabilities any crummy powers for rights or withdrawal. I'll talk about that in a little bit. Similar to the first party trust, the assets are exempt and not countable to the beneficiary. They can continue eligibility for Medicaid and SSI. There's no 65 age requirement. The beneficiary could be at any age when the trust is established and funded. And wonderful planning is that there's no Medicaid payback here. We could have this type of trust structure, and when the beneficiary passes away, to the extent assets are remaining in the trust, there is no Medicaid payback. The client chooses who the remaining beneficiaries are, and whether that's charity, the beneficiaries, if they have children of their own, if it's other siblings. So the grantor or the settlor or the creator of the trust is in control of that. So sometimes I'll talk to practitioners and, you know, or accountants, and they'll see on the left side of a 1041, you know, a box that says, you know, you could check as a qualified disability trust. Well, what is a qualified disability trust? Basically, it allows the trust, as third-party S&T, to receive a personal exemption, which in 2023, the personal exemption is $4,700. So that allows the first $4,700 of income to not be taxed in the trust. And you may say, well, but wait, I thought the Tax Cuts and Jobs Act of 2017 eliminated personal exemptions through 2025. It did, except for qualified disability trusts. You'll find the law of qualified disability trusts in Internal Revenue Code 642 B2C. A grantor trust cannot be a qualified disability trust. In order for and I call it QDIST for short, because it's a mouthful. So the statutory requirements for the trust needs to meet these requirements in order to be able to get that personal exemption on the tax return for the trust. The third-party S&T must be irrevocable. It must be for the sole benefit of the beneficiary with disabilities. We can't have other beneficiaries within the trust. The beneficiary must be under age 65 when the trust is funded. And you just said, wait a minute, Amy, you just said there is no age requirement for third-party trust. That is true, except if you want to get the qualified disability trust status, the beneficiary does need to be under the age of 65 at the time of establishment. And the beneficiary must have a strict definition of their disability as defined under the SSI and Social Security disability programs. Now, when we're doing planning, when I'm doing planning for clients, you know, we have different options when we're drafting these trusts. We could draft them as testamentary. That means they're created under a will. They don't get really established until the testator passes away and we go through probate. And depending on what state you're in, you know, the trustee who's named under the will for the trust gets letters of trusteeship, and that gives them the authority to be able to act. And then we have inter vivos trusts, which are created during lifetime. And these trusts can be irrevocable or revocable. I will say I'm not a big fan of testamentary supplemental needs trusts. Often we're dealing with trusts that are in place for the beneficiary's lifetime, which could be many, many years. And we want to have the flexibility to be able to change the trust or change the trustees, which sometimes can be done through the court, but it could take several weeks or if not a couple months, if not longer, to be able to even just change a trustee. And whereas if it's an inter vivos trust, we could do it in a day without having to go to the court and get court approval. Sometimes the court wants to appoint a guardian ad litem. It just takes what should be a simple process much longer if we're dealing with a testamentary S&T under a will. And so I would say the common planning by special needs attorneys is to do an actual trust agreement, a supplemental needs trust agreement that goes into effect now during lifetime. And then the question is, do we make that trust revocable or irrevocable? In my practice, we tend to, when I'm working with parents as clients and they have a child, whether it's an adult child or a younger child, with disabilities that we're anticipating to be lifelong significant disabilities, and a supplemental needs trust is appropriate, I tend to prepare revocable trusts. And that's revocable to the grantor, mom or dad, or sometimes both of them. That allows us to have the flexibility to amend the trust, for them to be the trustee, just make changes over the years. I will do irrevocable trusts if a family comes to me and we're doing estate tax planning, or we have other family members that want to make a significant contribution to the trust, not necessarily the grantor, mom or dad, will make the trust irrevocable. And so when we're looking at an irrevocable, I'm just going to talk a minute. I'm going to focus first on the irrevocable trust. And we're looking at the tax. So, the assets are in the trust, and to the extent that there's earnings, there's interest and dividends earned within the trust. There has to be tax that's paid. If it's a testamentary trust, we can, if the beneficiary is under 65 when the trust is established, apply the QDIS status to enable to get that $4,700 personal exemption. With an inter vivos irrevocable trust, it could either be drafted as a qualified disability trust or a grantor trust. And that's all dependent on the planning and what language we put in the trust, to whether maybe we want it to be a grantor trust, so that if we are doing estate tax planning, we want to preserve, if we want to make a significant contribution to the trust and preserve the assets within the trust, and have the grantor be able to pay the income tax on it, that's the strategy of doing that. And sometimes that makes a lot more sense to give a trust grantor trust status than to give it a QDIS status. And in terms of estate and gift tax planning, generally all the same planning benefits as your typical irrevocable trust. Except I just want to point out here, it's important not to give a disabled beneficiary crummy withdrawal rights and general powers of appointment. With the crummy rights of withdrawal, I've had several instances, more so in the last couple of years than I've had in the past, where there are pretty well drafted supplemental needs trust, or sometimes we're dealing with an insurance trust that has supplemental needs language in that. And when mom and dad go to apply for SSI for their child at the Social Security Administration, they'll ask, well, is your child a beneficiary of any trust? Oh, yes, we have this great, well-drafted trust right here. They turn it over. It goes to a review department somewhere in the middle of America with that's a trust that we as attorneys can't even speak to them, and they say, nope, this trust is denied. This beneficiary has crummy rights of withdrawal. So we have to, fix these trusts, sometimes through decanting, and to eliminate those crummy withdrawal rights for the beneficiary, so that they could be eligible for the SSI. And for some of my higher net worth families, they say, you know what, we really don't need the SSI for our child. We don't need a check of $900 a month. The issue comes, though, depending on certain states, such as here in New York, where I practice, we need that SSI if they're getting into some type of group home or residential placement that is administered through state agencies. They need that resident to have the SSI or Social Security disability eligibility, because that's how they get extra funding to be able to pay for that. Also, with the general powers of appointment, the idea is that a beneficiary can designate their creditors as a beneficiary, and so Medicaid will say, you know what, we may allow you to have this trust during lifetime, but at death, we're going to take an interest in this because you have a general power of appointment. So just a general rule of thumb, it's the same planning strategies usually as when we're doing high net worth irrevocable trust gift planning. But just these 2 points, that not to include the crummy withdrawal rights or general powers of appointment. And dealing with the third party supplemental needs trust, if a revocable trust, and it's important to know that only the grantor or settlor has the power to revoke, not the beneficiary. We don't give the beneficiary the power to revoke. The grantor pays the income tax. It's to the extent that the trust is funded during the grantor's lifetime, because sometimes we'll create these trusts and they're really not funded. They're meant to be funded through an estate plan or through life insurance or retirement assets, as of the grantor's death. But to the extent that it is funded, it's an incomplete gift for the grantor. It's includable. The assets are includable in the grantor's estate at death. But then there's a step up in basis of the trust assets. I've already talked about the benefits of the flexibility of having revocable trust. It all depends, there's no one size fits all. It all depends on the client's estate plan and the overall situation. The trust does become irrevocable, similar to a revocable trust that we do for clients, at the grantor's death. I do have a few minutes now, so I just want to spend a couple minutes on income and how income in the trust and estates world in terms of taxable income is a bit different than the special needs trust world or for purposes of benefits. So what is income? Benefits income is not the same as taxable income. The concept is often confused by Social Security and Medicaid workers. And so we find ourselves that we're often having to educate them about their own rules and the differences between taxable income for earnings or unearned earnings or for tax purposes, and then for benefits purposes. So for taxable income for purposes of trust and a tax, the distribution of income is either a distribution directly to or for the benefit of the beneficiary. Whereas in benefits income, for purposes of needs-based benefits, income is cash or anything that can be used for food or shelter, unless if it's something that's exempt, which is a different topic for another day. So with supplemental needs trust, here's a couple examples of when the benefits income is different than taxable income. So if we have a trustee of a special needs trust, pays for the beneficiary's telephone bill directly from the trust, sets up automatic, pays cell phone bill each month. The beneficiary has received a benefit and therefore has received taxable income to the extent is made up of distributed net income. DNI. In this example, the beneficiary did not receive any income for benefits purposes, however, because the beneficiary did not receive cash, food, or shelter. All right. And then here's another example. If the trustee of a special needs trust pays for the beneficiary's rent or food bill directly, so they set it up so that they pay the rent each month. And the beneficiary receives SSI here in this example, supplemental security income. The beneficiary has received a benefit and therefore has received taxable income to the extent it's made up of DNI, okay, traditional tax rule. But in this example, the beneficiary will lose 1/3 of her SSI benefit because the payment of the food and shelter by the trust is considered income to the beneficiary. And so, I leave with this point that, you know, for purposes of, the special needs trusts and a lot of the traditional tax rules apply. But when we factor in the benefits, there's, you know, um, different definitions of how income is defined and just the way that benefits work. So if there's ever any, questions, just feel free to reach out to me. And Jonathan, thank you so much for having me again today. I don't think we're doing questions, but feel free to send me an email, or which you could find as aohara@LittmanKrooks.com, or you can find me on my website.
Great. Thank you so much, Amy, for that informative presentation. If anyone does have specific questions, like Amy said, you could feel free to reach out to her or myself where appropriate. And I'm going to leave Amy's email address in the follow-up email to this program that come out tomorrow morning for anyone who missed it. And as I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my fall webinar series continues on October 26th on the topic of selling a family business, legal, financial, and estate planning considerations, featuring panelists Bernadette Kaznicki and Avi Sinensky, both partners at Rifkin Radler, based in Uniondale, New York, as well as Michael Richmond, who's the managing director at the DAC Group, based in Rochelle Park, New Jersey. And this program will be for CLE and CPE credit for accountants and attorneys based in New York, New Jersey, and Connecticut. If you have a friend, colleague, or client who'd like to be notified of my fall webinar series, they can just email me with the word webinar in the subject line, and I'll be sure to add them to my webinar distribution list. Second, you can follow all my work on Twitter, YouTube, and Instagram at Shenkman on Money, and you can also listen to my podcast called Shenkman on Money, which is available at Apple, Spotify, or wherever you get your podcasts. Third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.
Thank you.